Hi, Todd VanDenburg here with VanDenburg Capital Management and another Uncommon Sense update. So many things going on in the world that I could be talking about, but the only thing that seems to be on anybody's mind, at least from a financial standpoint, is Silicon Valley Bank. Um, so what I want to talk about today is sort of what's going on with the banking industry. How is it that Silicon Valley Bank failed? How is it the same or different than other financial institutions, and sort of what does this mean for the financial system in general in the United States? So to start off, for those that don't know, Silicon Valley Bank was, I think, the 16th largest bank in the United States. It had $180 billion of deposits, and it, basically went into bankruptcy last week. It got taken over by regulators. The FDIC has stepped in, and they're trying to figure out, what they're going to do to, provide insurance to people, to depositors. But then recently, I think yesterday, the government stepped in and said, okay, we're not just going to guarantee the $250,000 per account FDIC insurance amount. We're going to guarantee all depositors at Silicon Valley Bank. And I just see that as a huge issue, but let me explain why it's an issue for Silicon Valley Bank. And so 2 years ago, Silicon Valley Bank had 40 to $50 billion of deposits. And within 2 years, as I just said, it had almost $180 billion of deposits. So over the last 2 years, you're a bank, right? You get that much money coming in. And what you have to do is you either have to lend it out, which is tough to do when the Fed is, raising interest rates as aggressively as they have been, or you have to invest it somewhere or invest it. And so what they did with a lot of this money is they put it in relatively short-term treasuries, which sounded like a really good thing. Treasuries are safe and guaranteed. But here's where the problem came into play. So on a typical bank, a Wells Fargo, Bank of America, most of your local banks, small banks around the country, the overwhelming majority of the depositors are mom and pop, people like you and me, people that, they don't have more than $250,000 in any account. So FDIC has got, all of us 100% protected. But most of the depositors, like 90% of the accounts at Silicon Valley Bank, had more than $250,000 in it. The people who were the customers of Silicon Valley Bank were venture capitalists and venture capitalist firms and hedge funds, and they had huge amounts of money there, and they all knew each other, and they all talked, and not exactly 100% sure what the first domino to fall was, but somebody at Silicon Valley Bank took a bunch of their money out, a big chunk. And as I had said earlier, Silicon Valley Bank did the appropriate thing with all these deposits that they'd accumulated over the last couple of years. And, since they couldn't lend it, they went ahead and tried to earn some interest on it. Well, so here's the problem. If you bought a treasury, a year and a half ago or a year ago, interest rates were here, and interest rates have come up to here. They've significantly increased. And while you own this treasury and it's guaranteed by the government, you hold it to maturity, you get 100% of your money back, it's all good. When interest rates rise as quickly as they have, if you have to sell some of those treasuries to give cash to one of your big customers because they're withdrawing all their money, you have to sell those treasuries at a loss. So that's what they had to do. They sold treasuries at a loss. And then another big customer at Silicon Valley Bank gets wind of, hey, Silicon Valley Bank is having to, sell these treasuries at a loss. Maybe I should take my money out too. And then the dominoes just kept falling. So the more big depositors that left the bank, the more they'd have to sell their treasuries at even bigger losses because the Fed continued to raise interest rates. And finally, they reach a point where they don't actually have enough money, even though the things that they bought were 100% guaranteed by the government if held to maturity. um, because the depositors, left, and they left to go to, a lot of the bigger financial institutions. Um, they had no choice. They sold these bonds that were super high quality with decent yields, and they sold them at a loss. And now here we are. It only took like 72 hours from being a perfectly solvent bank to being, held by the regulators now. And again, as I mentioned, the regulators have now said that they're going to guarantee all of the depositors, even those that have accounts greater than 250,000. And this is where I see the problem is, the federal government has basically said, well, yes, we have FDIC insurance, but if something bad happens, we're going to protect above the FDIC insurance limit. Well, if you're a bank, you got to ask, well, then why are we paying for FDIC insurance if you're going to go get money from somewhere else, to cover deposits above that limit? It sort of, sort of hurts the underpinnings of the entire financial system. Now, Wells Fargo, Bank of America, Chase, none of these banks are structured like Silicon Valley Bank was. The overwhelming majority of depositors in most banks are just mom and pop. So it isn't that we're in, the front of a new financial crisis like it was in, the end of 07, early 08 and 09. This is not the same, but it's still painful, right? The markets, we've basically given up the gains for the year in the span of, 7 or 8 days, just because of fear. Now, we don't want to own financial services stocks because, the financial services industry is just getting hammered. And while it might come back, there was another bank, I'm not going to mention it, but because I don't want people trading on what I'm talking about. Another bank stock that it fell like by 60%, and then 24 hours later it was up by 60%. So this is speculation. This is now turned into a situation where people, the institutional traders are seeing the fear in the markets, and now they're just trying to benefit on it. And it's very much like the beginning of COVID. And several other times over the last 5 to 7 years, where the institutional traders see the fear and then try to make money on the fear. So we are and have been for a while now, slowly pulling back on our exposure to equities, putting some strategies in place to try to protect our downsides, increasing our exposure to treasuries, because we're not going to get forced to sell our treasuries, so we can hold them to maturity. But this whole Silicon Valley Bank thing, it's not the end of the banking system. It's not the end of the financial system. But what it is there's a dialogue that has to be had regarding the government's intervention in a failing bank. Because if you think about, the whole point of FDIC insurance is to let people know, hey, don't keep more than $250,000 in any account at any institution, because if you do, that's not protected, and if that institution goes down, you're going to have to eat the loss. Well, by stepping into Silicon Valley Bank and guaranteeing all depositors, they've now set up a situation where people are like, well, then maybe I can have more money in an account or at a bank than FDIC insured insurance covers. It's really muddying the waters because there's no guarantee, right? There's no law that says that the government has to step in and make all depositors whole. The government tends to selectively do this. And I will make one slightly political comment. When you look at the people that are the largest depositors at Silicon Valley Bank, they tend to be big political donors. So it's not a shock that the politicians have decided that they're going to protect depositors at Silicon Valley Bank, because those are the people that are contributing to their reelection campaigns. But we shouldn't expect it if, like, a local bank in your town goes belly up. don't expect the Treasury or the federal government to step in and make every depositor whole, because that's not what the law requires. And when the government does this, it tends to do it selectively. One last thing is, I was just reading this earlier this morning, is on the board of directors of Silicon Valley Bank, you would think it would be a bunch of people who have a bunch of experience in financial services, but of all the people on the board of directors, only one person had prior banking experience. So it's, the head of risk was spending most of their time in the last several months, doing activities that had nothing to do with monitoring risk. It was, doing ESG type things, and I'm not going to explain that. I did it in a prior video. But it's the whole concept of, if you go woke, you go broke. Well, therein lies Silicon Valley Bank. They were spending too much of their time, not necessarily paying attention to, the finances of the bank and what was going on with their depositors, and too much time on other things. And so as the dominoes started to fall, they just didn't have any options. I mean, they were saying 24 hours prior to them, being seized by the government, that it was all fine, that they had plenty of liquidity and it would all be good. So the markets are volatile, no doubt. Again, we've given up our gains for the year, just because that's, people are selling stuff, and coincidentally, they're not selling, going to cash and taking it to their bank. Now we've got a lot of people buying treasuries. So just a month ago, you could get a 2-year treasury at approaching a 5% yield, and now it's like 2.6. Simply because so many people are buying treasuries, it's pushing the price up, which pushes the yield down. So this is not the time to panic. It's not the time to go crazy. But if you own more regional type bank stocks, you might want to take a look at that and say, maybe I want to pull back my exposure a little bit, because runs on small banks, especially if they have a disproportionately large number of large depositors, can cause a bank to go insolvent pretty rapidly, again, as we saw with Silicon Valley Bank. So there's no solution here. It's just, I think we need to be a little bit patient with the volatility, because a big chunk of the volatility, I mean, people are selling everything because a bank that was not well diversified has been seized by the government and by regulators. That just seems a little overblown to me. Now, could it continue? Could the market volatility continue, and could it get worse? Well, yes. Sometimes we cause the thing that we fear, right? If we all take all of our money out of our local banks, we can cause them to go belly up. And we can say, oh, see, I got my money out, and that's a good thing. But it wouldn't have gone belly up if people hadn't have taken their money out. And the same thing goes for your investments, your long-term equity portfolio. If we're concerned about bad things happening, and we take actions that accelerate the bad thing happening, then we shouldn't be surprised when bad things happen. So again, there's no fundamental issue with the U.S. Economy or financial system. Just the same old, inflation's too high. The Federal Reserve is raising interest rates super aggressively. I will end on one last comment about the Federal Reserve. So, the Federal Reserve had just put out, literally like a week ago, that it was expected that they'd raise rates again another 0.5% coming up here, I think next week. And now, based upon their actions, right, they raised rates so quickly that it contributed to the demise of Silicon Valley Bank, and it's been causing all other kinds of heartache in the U.S. economy and housing. Lenders are not able to lend or not lending as much money out. People are not building as many houses. It's having a real impact, but I don't think that the Federal Reserve, the Treasury and the Federal Reserve anticipated what's going on inside the banks as a result of rising interest rates. So Now there's some talk that maybe the Federal Reserve won't raise interest rates this next time, or if they do, instead of being 0.5%, maybe it'll be 0.25%. So we're going to monitor that pretty closely because, again, we think that they've raised interest rates too quickly, and that they're going too far, because what they're doing is just hurting sectors of the economy. It's not having the impact on inflation that they expect. And in order for them to really have the impact on inflation, they have to practically cripple the economy. And how is that good for us, right? Do we really want 7% unemployment again? Because but low inflation. So food doesn't cost as much, but you don't have any money to buy it. That's the Fed's plan right now. And so we're sort of watching it closely and see whether they moderate their steps to address the reality of what's going on in the world right now. If they do, then that's a good thing. Then that at least shows that they're paying attention. And if they don't, then we potentially pull back a little more from equities and we add a little more to things that have some buffers, some protection around them, and some treasury type fixed income, because you can't fight the treasury. So sort of a long update. I said Silicon Valley Bank too many times. If it were a drinking game, people would be drunk by now. But that was your update. If anybody has any questions about this or any other financial issue, please do not hesitate to call, email, text, post a message to this video. Ask questions, so that you're not taking actions based upon your fears or your concerns, and that you're really making decisions based upon data and math, because that's what's going to protect you in the long run. So that was your update. I hope you enjoyed it. If you did, give us a like, give us a share, and I'll be back again soon with another Uncommon Sense update. Thanks for watching. If you'd like to be the first to hear of more Uncommon Sense updates like these, please click the subscribe button below. We'd really appreciate it. Thanks again.